Who really makes money every time the Indian stock market moves? Think about the last time you bought a stock. Maybe you opened Grow, Zerodha, or Angel One, tapped buy, and watched it appear in your app within seconds. To you, the broker did all the heavy lifting. But behind that smooth user interface lies an invisible financial giant. Every single time you sell a share, a tiny fraction of a rupee is pulled out and paid to a company you've probably never interacted with directly. It doesn't matter if the market is crashing or hitting new all-time highs. It doesn't matter if you make a massive profit or lose your shirt. This business gets paid regardless. Welcome to the hidden monopoly of CDSL, the central database holding the digital wealth of over 18 crore Indian investors. Today, to understand why CDSL is so valuable today, we have to travel back to the early 1990s. Back then, investing in the Indian stock market was practically an extreme sport. Shares weren't digital. They were physical, printed paper sheets called share certificates, and the system was broken. If you wanted to sell your shares, you had to physically mail those certificates across the country to a registrar. It took anywhere from 14 to 30 days just to settle a single trade. Even worse, between 20 and 30% of all trades suffered from what the industry called bad delivery, canceled transactions because a signature didn't match perfectly, or a name was misspelled. Theft, transit hijacks, and sophisticated forgery ran rampant. The structural breakthrough came with the Depositories Act. So, how exactly does this system work? And how does CDSL sit quietly right at the center of it? Think of a depository like a bank, but instead of storing cash notes, it stores digital representations of your stocks, mutual funds, ETFs, and corporate bonds. As a retail investor, you can't walk up to CDSL and open an account directly. Instead, you go through a depository participant, or DP, which is usually your broker. When you buy a stock, the exchange matches the trade, your broker processes the request, but the ultimate legal ownership record is hard-coded directly into CDSL's secure ledger. This architecture gives CDSL two primary, beautiful streams of income. The first is transaction charges. Every single time you sell a stock out of your Demat account, CDSL charges a flat fee of a few. Now remember, India is a regulatory duopoly. There are only two players, CDSL and NSDL. No third competitor has entered this space in over 25 years, and frankly, none are expected to. The regulatory barriers erected by SEBI are incredibly steep. To build a new market infrastructure institution, you need massive initial net worth, bulletproof national cybersecurity frameworks, and a willingness to absorb millions in fixed costs before seeing a single rupee of volume. But here is where the story gets fascinating. Even though it's technically a duopoly, look at this market share chart. Over the last decade, CDSL didn't just compete, it completely ran away with the retail market. As of 2026, CDSL commands a staggering 81.8% market share of total active Demat accounts in India. Itway. The answer boils down to one brilliant long-term strategic bet. CDSL allied itself with the tech disruptors. Historically, NSDL focused heavily on institutional investors, foreign portfolio managers, and traditional high-net-worth bank brokerages. Their pricing model was premium and structured around corporate asset custody. CDSL took a fundamentally different path. They designed a highly affordable, tech-first, flat fee structure and pitched it straight to the early discount brokerages like Zerodha during the mid-2010s tech boom. When platforms like Grow, Zerodha, and Angel One scaled up to capture millions of millennial and Gen Z investors, they natively hard-coded CDSL directly into their software backends. So for the past decade, whenever a retail user signed up on a modern fintech, let's look at how this operational dominance translates into hard financial performance. CDSL's financial numbers read like a software company's dream. Back in FY20, their total operating revenue was a modest 225 crore rupees. By FY24, that number exploded to nearly 1,200 crore rupees, stabilizing at an impressive 1,239 crore rupees in our latest audited numbers for FY26. Even more remarkable is their profitability profile. Because the underlying business model is fundamentally an asset-light database, it possesses immense operating leverage. Once their fixed tech infrastructure, servers, and regulatory teams are funded, nearly 70 to 80% of every new rupee they earn drops straight down to pre-tax profits. This allows CDSL to consistently maintain consolidated EBITDA margins hovering well. This brings us to why investors view CDSL as an exponential macro bet on India's structural wealth. CDSL acts as a direct proxy for the financialization of Indian household savings. For decades, Indian wealth was locked away in physical gold and real estate. Today, there is a generational shift underway. Systematic investment plans, or SIPs, are hitting record highs every month, and retail participation in IPOs is exploding. Every single time a new citizen enters the financial markets, buys an index fund, or applies for an IPO, CDSL wins. And despite crossing the historic milestone of 18 crore active accounts, the structural runway ahead is still massive. Total unique equity participants still represent less than 10% of India's overall population, as that penetration climbs closer to dev. But let's pause. No business is without risk, and as disciplined investors, we have to look closely at the bear case. CDSL faces three material risk vectors. First is regulatory price intervention. Because CDSL operates as a critical market infrastructure institution, its pricing power is heavily regulated. It cannot simply raise transaction prices to maximize profits. In fact, SEBI can step in at any time and mandate fee reductions or alter KYC pricing structures, just like we saw influence margins recently, via its KYC subsidiary, CVL. Second is market volatility and cyclicality. While annual issuer corporate fees provide a very safe revenue floor, transaction fees and new account creations depend entirely on market sentiment. If India enters a prolonged, multi-year secular bear market. So what is the final verdict? Is CDSL merely a basic financial utility, or is it one of the most powerful monopolies in India's capital markets? The data gives us a clear answer. By locking down the infrastructure layer of the fintech ecosystem, CDSL has turned a regulated duopoly into a functional retail monopoly. It features an asset-light framework, exceptional return ratios, a rock-solid balance sheet, and a recurring revenue stream tied directly to the growth of the Indian economy. While ordinary investors will continue to log into their favorite trading apps completely unaware of its existence, CDSL remains the invisible, irreplaceable core infrastructure of India's stock market. But what do you think? Does CDSL deserve its premium valuation, or do you think regulatory change is